Um, you have different kinds of investors. Some of them cannot bear risk. Their risk appetite is relatively uh, very low compared to some other classes of investors. And so, if you have that desire for regular income and you cannot really bear the kind of risk that is obtainable in the stock market, you could invest in treasury bills. It is a safe short-term investment that guarantees regular income. So I want to talk about the features, the characteristics of treasury bills. Treasury bills are short-term securities issued by the federal government with the very aim of raising capital for its operation to sponsor infrastructural development and other government commitments. So here are key features of treasury bills. Number one is issuer. The issuer of this bill is usually the central government and is backed by the capacity of the government to not to default, the capacity of the government to pay both the principal and the regular interest at maturity. So it is a kind of government-backed security. As that particular, is backed by the full faith and credit of the issuing government. Number two is maturity. So treasury bills have a short-term maturity ranging from typically 4 years, 13 years, 26, or sorry, it's not years, it's weeks. 4 weeks, 13 weeks, 26 weeks, and even a year. Typically, it is a year and less, between 3 weeks, between 4 weeks and a year. In other words, between 1 month and 1 year. It doesn't really go beyond a year. So it's a very short term kind of instrument. Number three is discounted price. Treasury bills are sold at a discount to their face value, meaning they do not pay periodic interest. Unlike bonds, bonds are sold at face value and they pay interest. When it comes to treasury bills, unlike bonds, treasury bills don't really pay interest. I was earlier talking about bonds. I'm talking about treasury bills this time around. So they don't really pay interest. Instead, investors purchase them at less than their face value or their par value with the full belief that at maturity they'll be able to sell or get their full money back. Let me explain. Let's take, for instance, let me use my country's currency. Let's say a treasury bill is selling at has a face value of let me say 1,000 naira. 1,000 naira. So the government may decide to sell at maybe 800 naira or 900 naira or 700 naira, as the case may be. So you are buying this instrument at, let's say, 800 naira. So after maturity, the government will give you 1,000 naira. You understand? So you gain 200 naira. 200 naira out of 800 naira is 25%. Yes, that 25% gain. So they don't pay interest. They only sell at a discount. That's a typical attributes of this particular kind of investment compared to bonds that gives you regular income. Number 4 is no interest payments. Treasury bills don't pay interest. So you get what you get to like gain whenever the money the government pays you back your capital with an interest on it. you know so the returns is the difference between the purchasing price and the face value you receive at maturity. And of course, the face value is always very high. It's always relatively higher than the purchase price. Number 5 is low risk, considered one of the safest investment one could think of because it's backed by the government, and there's less risk of default. Number 6 is liquidity. Treasury bills are highly liquid. You could very easily trade them in the open market. The liquidity is here. You can very easily buy and you can very easily sell in the open market without difficulties at all. Number 7 is face value. So these are issued in a denomination of let's say $100, and the investor receives the full face value at maturity. It's a very, very interesting kind of investment. Actually, you pay less, and then at maturity you get something more. So the difference between what you pay and the par value, the face value, constitutes your returns, constitutes your interest in the absence of regular regular coupon payments as it's obtainable in other kind of bonds. Number 8 is tax treatments. When it comes to tax treatments, the interest income, the difference between the purchasing price and the par value, is subject to federal income tax, but is exempted from state and local government taxes. So only the federal government would charge you an amount as tax, but the state governments and the local government will not tamper with your interest. Please like this video and subscribe to this channel if you've not done that. And number 8 is the yield. The yield on treasury bills is calculated based on the difference between the purchase price and the face value. I've earlier explained that this yield is if you buy at, let's say, 800 naira and the government returns gives you 1,000 naira at maturity, the yield there is 200 naira. Number 10 is auction process. Treasury bills are sold at regular public auctions where investors can bid competitively or accept the discount rates that the government sets. So either the government set a discount rate or you can bid for it. So the highest bidder would be able to invest. Number 11 is there's no call feature. Unlike government bonds and even corporate bonds, the government cannot redeem, cannot call back kind of treasury bills. You can't redeem it. You cannot call back. You cannot redeem it before maturity. Of course, the maturity date is very, very, very small, just from 4 weeks to a year. So that callability, that call feature is not there. Number 12 is you could use it in portfolio diversification. You want to diversify your portfolio from traditional investments or from other kinds of bonds like government and corporate bonds. You can insert treasury bills into your portfolio mix. It serves as a guarantee against fluctuation in returns in the portfolio. It reduces the overall portfolio risk. Number 13 is it's a short-term investment compared to bonds that would have maturity period of as much as 35-40 years, like in the government bonds. This other one, the maturity period is highest is 1 year. So it's good for those who want short-term investment, who don't want to tie their money down for a very long time. Maybe you have a project to execute in the next 12 months. So you can invest in it, get your money back, and then invest in your project. So treasury bills are widely regarded by their safety. They are regarded for their safety, the liquidity, the simplicity, making them an attractive choice for investors and seeking to preserve their capital and make a predictable low risk return. It's a very interesting kind of instrument in the sense that there's no regular interest being paid out like what is obtainable with bonds, but you buy at a discount and then you sell almost like the government pays you back your money at face value, at par value. Then you get the difference, the yield as your returns.